Liquidity is king. That's what we have learned, some painfully, in March. The month started very good when you look at risky assets, as there were no clear signs that the previous rate hikes have led to signals that the economy is slowing down immediately. At the same time, we have seen that inflationary pressure is still very high and that central bankers are still there to fight it. And we have seen some clear signals from central bankers that they want to go ahead with additional rate hikes. The market took this into account, and we have seen a further increase in longer-term bond yields. This environment has changed rapidly at the time when the problems about the Silicon Valley Bank became apparent. This bank had specific problems. They were not able to manage the increase in interest rates in their interest rate and risk management. And on top of this, we've seen that the supervision in the US has changed in recent years and did not have those banks in focus anymore. So what happened at Silicon Valley Bank is not systemic. But what is systemic, and we learned this in Europe as well, is the fleetness of liquidity. This is a really scarce thing, and when it comes to problem in one area, liquidity is very abundant. Because of this, we have now seen that the funding costs of the banking sector is going up. And despite no further tightening in monetary policy, the impact of the previous rate hikes is now becoming much more painful for the rest of the economy, as the transmission has changed. And because of this, we think that the economic outlook is even more uncertain as it used to be, and we do not go ahead with an increase in our growth forecast, what we would have done without these occurrences in March. So we still expect a recession in Europe and in Germany, and a technical recession in the US. Regarding monetary policy, the events in March made clear that the room for further interest rate hikes is limited. And we only expect one further interest increase by the Fed and the ECB in May. And the ECB probably will come up with some additional liquidity support measures as well in the next couple of months. Even with those measures and less interest rate pressure, the environment will remain choppy, and banking problems will lead to turbulent market developments in coming weeks.